For example, here we have a bullish candle, which is then followed by a candle that has created a liquidity sweep on the candle range high. And with only this information, we might expect the third candle to push down and attack the candle range low. But whilst this setup might look promising at first, the crucial part that most traders overlook is making sure that the setup actually makes sense within the context of the external market structure. So now that we can see the full range from which these candles were taken from, when we analyze further into the chart, we can actually speculate that this CRT setup is highly likely to fail, because in order for the price to push down and pass the candle range low, it would need to overpower this bullish fair value gap that also happens to be overlapping with a bullish order block. So now that we have done some further analysis, our bias should actually lean more towards being bullish, which opposes the idea behind this CRT setup. And then when we move forward in time, as expected, the setup does end up failing due to the strength of the buying power found in the bullish PD arrays. And now moving on, here we have another potential candle that we can use for a CRT setup. But this time, the setup actually has great potential because it has occurred at an important point of interest, which is this attack on liquidity. And the way we should think about candle range theory is that it is essentially a method to signal a reversal of the price's direction, which makes it a great tool to use during an attack of liquidity because it can help us analyze whether we are seeing a liquidity run or a liquidity sweep within the moment that it is playing out. But keep in mind, we would also have to assess the lower time frame's market structure to really have an understanding of what the market is wanting to do. And this is because we should never take a trade using the higher time frame without understanding how the market structure is forming within the lower time frames. Another great way to use CRT is when the price is drawing into a PD array, such as this bearish fair value gap here. The reason being is that after the change of character, we should already be under the belief that the price is likely to reverse from this zone. So we can use candle range theory to find the confirmation on whether this fair value gap is being respected. The takeaway is that candle range theory can be a very useful tool within your trading analysis to identify and trade reversals in the market, but it's also just as important to understand when you should actually use it. If you found this video helpful, please leave a like and then comment what trading concept you'd like to see us cover next.